There's a report out today in the Telegraph. Worst fund managers take $500 million in fees from investors. Even in a flat market, these funds would together charge their customers £463 million in fees. Dated 12th of February. This is absolutely appalling. It is daylight robbery, and I'll tell you why. It is not because they've underperformed in a month. That could happen. Or just for a day. That could happen. We're talking about underperformance over a 3-year period. And we're talking underperformance by as much as 32%, 26%, 29%. Let's look at the first one of these, the 32% one. Is it from some fund that nobody's ever heard of? Maybe some tiny little company? No, they've got £3.9 billion and it's JP Morgan. Okay? US equity. So it's not as if they're picking from a niche category of stocks. So, poor things. What could they do? They've underperformed their benchmark by 32%. Now, how did they manage to do this? Because it would require some degree of skill over a prolonged period of time to have £3.9 billion yet be so rubbish. And I mean rubbish because if you underperform for 3 long years your benchmark, that is not an accident. That is an ultimate lack of skill. So let's see. Well, it doesn't help that Morningstar or the dimwits at Morningstar give them a silver rating. And 4 stars, that sounds like, it must be a good one. Yeah, they really help in the marketing, don't they? And the whole point of retail fund management is it is a marketing business. It is to market people who know no better, know not what to look at, and therefore get the money in. £3.9 billion. Yeah, their kids are going to private school. Are yours as investors of this fund going to private school? I doubt it. And guess what? They get to keep charging you 1.56%. Doesn't sound like much, does it? It does when they're depleting your capital. So Claire, David, Andrew, Fiona, Christian, take a bow. Seriously, please look for another job because you're ruining the lives of people. How do I know you're ruining the lives of people? Well, that's your benchmark there. Okay, S&P 500 index, net of 15% withholding tax, which is fine because it's to do with income and dividends, blah, 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 blah. Okay, that's the underperformance. Pretty much every single plumbing year, month, all the rest of it. Right? Am I saying I could do better? No. I tell you what I do say. Well, actually, I could do better. But let me tell you what I do say. I say, see that grey line? That's an index tracker. Why the hell don't you just tell people, listen, don't invest in us, put it in an index tracker? Or why don't you just tell people, listen, you know what? We're going to just buy the index tracker for you because you don't know what you're doing. You're happy to follow our advertising and invest in this. But you know what we'll do? We'll just put it in the tracker for you guys, okay? That'd be make a hell of a lot more sense. Now, I don't have a problem with what their top 10 holdings are or what the sectors are and all the rest of it, and it all sounds wonderful, and look at all this risk and everything else, and they'll talk to you at great length. You've got all this information available on the internet. No warnings from all the ratings agencies, by the way, is there ever, okay? But what happens at the end of it? What happens at the end of it when you look at all of this? Well, you've underperformed, and over a prolonged period of time. So there can be no excuse. It is not my job to feel pity for you because you're getting paid bazillions. You're getting paid lots and lots of money. Too much money. Too much money, as my son would say. It's too much, right? Wrap up, or just take the 3.9 billion and please put it in the benchmark index tracker. That way, everybody's a hell of a lot happier. This retail fund management industry really needs to be cleaned up. This is not the first time it's happened. I discussed it in my Financial Times columns. I've discussed it on my Bloomberg TV show. I've written books on the subject published by the FT and by Macmillan. Does anybody listen? Of course not, because I'm up against trillions in marketing so they can get all the assets under management in the world. Anyway, if you want the list of shame, there we go. JP Morgan, Halifax, Bank of New York Mellon, Invesco, St James's Place, Fidelity, M&G, Hargreaves Lansdown, Scottish Widows, Halifax, Invesco, SJP. Give the fees back. Give the fees back to your clients. When you underperform, give them back. You know why? It's in the years when you do perform, you can charge in those years and you can keep it for the years when you underperform. So give the fees back because trust me, you're rich enough as fund managers. And not only that, JP Morgan, give the fees back, you're rich enough. Halifax, give the fees back to your clients, you're rich enough. BNY, give the fees back, you're rich enough. And so it goes on. Not one of these is a tiny little startup where people thought, oh, I'm taking a bit of risk by putting into this. You know what's even worse? Look at these lovely little words, these global equity. You think you're safe there, don't you? US equity, surely they'll do well. All right. UK growth, they've got widows in the title. Surely they can't mess things up. They must be taking low risk. They may well be taking low risk. But that doesn't help you, the underperformance. And you might say, well, better that they gave it to those fund managers than the people, lost it themselves by gambling on the market. Yeah, people's alternative wasn't a rubbish fund manager or gambling on the market. It was a rubbish fund manager or an index tracker, such as an exchange-traded fund, right? That was the alternative. And that alternative, as the data proves, and this article from the Telegraph proves, is better. Is better. Warren Buffett says it's better. Okay? Spokesman for St. James's Place said, I love these comments, they could be politicians. Last year, we continued to take steps to future-proof the performance of our funds and portfolios. You took those steps last year. What the hell were you doing for the previous 2 years when you were underperforming? This includes merging funds, introducing over a dozen new fund managers because our existing ones are really crap and not hungry because they're fat and bloated on the fees, and removing risk by pairing managers with complement. Blah, 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 blah. All right? What a load of crap. Seriously. I'm all right because I manage my own capital. But seriously, everyone else, really look into this stuff. There is a tragedy going on in this area. Oh, I'm glad they mentioned Neil Woodford. Yeah. Well, us in the investment management industry knew he's been rubbish for a long time. If you underperform consistently, I don't mean over a year. I don't mean over a month. I don't even mean over 2 years. Consistently, you're rubbish. I don't care how long you've been in the industry. You're doing it wrong. You're doing it wrong and you don't know what you're doing. You think you know what you're doing. You don't know what you're doing.